bank earnings season ramping up, and a lot of our big lenders are trading at or near record highs. Scotiabank turned in its first quarter report card, beat expectations with higher profits across its business segments. Let's get some more from Brian Belski, CEO and Chief Investment Officer at Humilis Investment Strategies. Brian, great to see you, and thanks very much indeed.
Thanks for having us, Andrew, and good morning, Canada.
What jumped out for you with the Scotiabank numbers? Anything interesting?
Well, I think, the big six banks have done a wonderful job in terms of managing their capital. We've said for years and years that Canadian banks are the most excellent stewards of capital in the world. And, last year, meaning 2025, was a year where the banks were starting to use off of the excess reserves that they were really building through much of 23 and 24. And so the benefits of that are really even following through into this first fiscal quarter for 2026 for the banks. We worry that the Canadian economy might be slowing a little bit faster than the U.S. economy. We worry that Canadian banks in general have had such great performance from a fundamental perspective. That they've spent a lot of money with respect to divisions as well. But Scotia in particular is going to follow and set the trend for what we believe we're going to see for the rest of the banks, meaning good capital markets perspective and volumes during the quarter because of the volatility. Wealth management, especially at Scotia, they've kind of righted some of the branding ships and some of the issues that they've had there. So I do think that Scotia's kind of setting the pace in terms of some of the other banks. But by and large, the banks in general, we think in our view at Humilis is that the banks are going to be much more selective versus last year. They all kind of went up in unison. So you're going to have to increase your stock picking chores within the big six banks.
So, but Scotiabank would be one of the bank stocks you favor, Brian?
Well, we own Scotiabank in one of the 8 model portfolios that we run for clients, both Canada and the United States. We own it in our North American dividend growth portfolio. This is a company that has consistently raised its dividend over time and has great free cash flow yields above the dividend yield with respect to being more tactically positioned in national. I think there's other banks like RBC and National that we would prefer with respect to tactically over the next 12 to 18 months.
Royal Bank and National. What would appeal to you with National? I mean, they have been growing rapidly. They just pulled off a big acquisition. Is that part of it as they squeeze profits out of that?
Well, I think number one, management. Their management has been in place for a while, especially relative to some of the other big banks. And number two, they pulled off a great acquisition out west. And as you know, the West is growing from a population perspective and a GDP perspective a little bit more consistent than what we've seen in the East. And number three, from just a pure growth perspective and how they manage their individual divisions, we have a lot of confidence in.
What about the big U.S. banks? Are they drawing your attention at all, Brian, the JP Morgans and the Bank of Americas?
Yeah, Jamie Dimon once again sets up for everybody to be worried. He likes to underpromise and overdeliver, and he puts his money where his mouth is. Remember, he was one of the CEOs that still remained from the credit crisis, and he's been making comments with respect to what's been going on in terms of private credit, but then also AI. Two of the things that most investors are worried about with respect to financials. We still love financials in the United States from a thematic perspective, Andrew. And the themes are kind of a big barbell. On one side, we like the big banks with respect to the scalability of JP Morgan, Citigroup, Bank of America, especially Bank of America in terms of their Merrill Lynch division. And then we like the really small banks because of the relationships that they're able to maintain with respect to growing the commercial banking side and the individual banking side. So the in-between banks, quite frankly, more the super regionals are the ones that we more worry about because we do think they can't compete with the small and they can't compete with the big. So I think the banks that you just had up there, including Wells Fargo, I think from over the next 12 months are where you want to be, especially as I think a lot of people are forgetting that regulations are going to go down in the big banks and the funding mechanism, we think, as interest rates continue to go down as well, that affordability is going to get better. And we're going to have another real estate increase in terms of real estate prices continuing to go up.
Brian, what about Home Depot? You say investors should watch out for misleading signals here?
Yes. Now, Home Depot is a bellwether retail stock. Now, remember, in the fourth quarter, people spend their money in the United States a little bit differently than they do the rest of the year. Last year in 2024, we had an additional fiscal week as well for the fiscal year. So that was what the numbers are a little squishy. If you look at continuing operations earnings on Home Depot, they beat the number. Home Depot is about the consistency in earnings for Andrew. It's not about this go growth side of things. And especially given the fact that consumer sentiment has been weaker, Home Depot is an area where it's more actually of a consumer staples retailer, and we've owned it for several years in the portfolios that we've been able to run. And so Home Depot, we think, is one of those names that you want to own in a market like this.
What about the U.S. consumer, Brian? We've heard endlessly about the so-called K-shaped economy, the lower income people struggling. Any thoughts on that? I mean, are you avoiding companies that tend to be more dependent on lower income people's spending habits?
No, because if you take a look at where, let's say, where Walmart has done the last, let's say, 12 to 24 months, low income to medium sized income are still spending their money at Costco. Costco, we believe, is a top 25 company in the world. And then if you also take a look at where Amazon, in the price differential and the price breaks that they're giving investors, Amazon underperformed last year. And a lot of people missed that. I think the consumer discretionary sector last year had a much more volatile time. Remember, Tesla is part of the consumer discretionary sector. So that's what really drove that sector higher, where Amazon had more issues. And Amazon was really beaten down from the AMS division, not so much with respect to what's going on with the consumer. So from the pricing side of things, investors in the United States especially are much more price conscious. They're smart about how they're going to buy things and buy things in volume. And I think that's why the Costcos, the Walmarts, and the Amazons from us still make a lot of sense. And then from a thematic perspective, from smaller mid-cap stocks, we still like a stock called Shake Shack because we do believe that company is the next big theme in restaurants. And we do believe that the volume and how they're opening up stores, Andrew, is very, very smart.
Shake Shack, yeah, excuse me. I believe part of their shtick is our burgers are better quality.
They are. So, our theme for Shake Shack is we think Gen Z is to Shake Shack what millennials were to Chipotle. Millennials like to be a little bit more healthy. Shake Shack is talking a little bit about that, but Gen Zs are about living what's going on right now today, living today, and they want to go have their burger with their large pop and their French fries. And I think that's a major theme, and why Shake Shack, we believe, from a fundamental and thematic perspective, is much more positioned better, than Chipotle.
Thank you very much, Brian. Always great hearing from you. Brian Belski,
Thank you.
CEO and Chief Investment Officer, Humilis Investment Strategies.